Right, so we're going to get straight into it. Now, they say avoid technical topics during the graveyard slot, and what have we done? We've put a technical topic in the graveyard slot. But this is very, very pertinent from the conversation we just had on the panel about lessons learned, because if there was one thing that Silicon Valley Bank and First Republic Bank got wrong with last year, or in the period leading to last year, it was their interest rate risk management, alongside their liquidity risk management. I think they got that 100% wrong as well. But the catalyst that kicked off the loss of confidence, which resulted in the bank run for those three failed banks, was no attention to interest rate risk. So we have got someone who has been there, done that, worn the T-shirt in managing interest rate risk. My close personal friend, Chris Westcott, ex-RBS Group Treasury, as am I, he's going to talk us through for the next half an hour on the key points that we need to keep in mind in managing this very important balance sheet risk. Chris, the floor is yours, sir.
Is this working? No?
Can we have this mic, please, Mahmood? 222.
Hello?
Great.
Yeah, that's working. Right. So there's nothing worse than being given the graveyard slot and then being told that your audience won't be a technical audience because we're opening it up to the whole room. So the plan is, and please bear with me, same slides, but I'm going to try and weave my way through them in a completely non-technical way with the hope that we all take something from the discussion. That's the aim. You can score me afterwards. Whoops. Okay, let me just move this so I can see the screen. This, in theory, would have been what I'm going to cover, but as I say, I will pick on certain parts of it. I think I will pick on why it's important for banks to manage interest rate risk. And you'll see there in the heading, it says interest rate risk in the banking book. So just to be really clear, a lot of people involved in this conference who speak may be involved with the trading side of a business. We're not talking about that. We're talking about the banking side, so it's the branch, it's the deposits, it's the lending, it's that kind of thing. And that can generate interest rate risk. So the very first question is, does that matter or not? Is it the kind of thing that can affect banks or not? And then, broadly, the rest of the agenda there goes through a number of different types of interest rate risk and how you might manage them. Now, my aim over this, as I say, is just to touch almost on the headline, move on, and maybe stop in a couple of areas that are of interest to you guys. So the very first thing, when you look at a profit and loss account, that the chart that you'll see on the right-hand side, it will often look something like you're seeing there. So it'll start with interest income and interest expense, get to net interest income, then you add a few things like other non-interest income, trading income, that kind of thing. That gives you total income. And then you take off things like operating expenses, impairment losses to get to your pre-tax profit, and then take off your tax, and you finish up with the bit you attribute to shareholders. For most commercial banks, that top bit on interest will make up anywhere between 50 and 80% of their total income. Net interest income is 50 to 80% of total income. So, however you cut it, it's important to banks. If we just picked up, and funnily enough, in the last conversation, we talked about banks failing. Well, here's a few big bank failures over the years. And if we just take a really quick look at them. So, Herstatt was about foreign exchange problems. Continental Illinois was about commercial loan portfolio. Savings and loans was about excessive lending. BCCI was fraud. Barings was fraud by the head trader. And Washington Mutual was losses in the mortgage market. So, I mean, this is not every failure, but these are some of the really big ones, or notable ones, and none of those are particularly related to interest rates. And although this chart's quite a long way out of date, by the way, all these charts will be available afterwards. You're welcome to take photos if there's anything useful, but I'm sure you'll be able to get them later as well. If we were to look at the characteristics of a failed bank, quite often there's the emphasis on really bad credit policies, really bad management, poor governance, that kind of thing. And if we look at failure to follow asset and liability management policies, of which interest rate risks could be one, we'd see that over the period that this was worked out, and I've said it's a little bit out of date, but nevertheless gives an indication, about 50% of bank failures have something to do with asset and liability management policies. This one is a bit relevant to SVB, and actually picking up on one of the points Murad made earlier, he talked about someone who thought the problems at SVB were down to the fact that the Federal Reserve raised interest rates too quickly. I actually have a little bit of sympathy with that. If you look at the chart on the left, it gives an indication of the path of Treasury bond yields, and you'll see that they shot up. And the chart on the right looks at the value of bank assets, particularly their holdings of government bonds. And where you see the blue area, that's basically losses that the banks have that they have not recognized. So as we can see, this is not just SVB, this is all the banks in the system. When interest rates shot up, banks who were holding bonds were sitting on mark-to-market losses. They might not be recognizing them because of the way they accounted for them, but they were sitting on them. And that was quite significant. So this chart kind of starts suggesting that interest rates could matter a bit, even though we haven't seen many bank failures due to interest rates. If we now look at SVB, there's a little bit of a history about exactly what happened, but broadly speaking, SVB had massive concentration in its dealings with the, venture capital related to technology. And if nothing else, that should have been a red flag to people. Also, one of the characteristics of SVB is that its balance sheet grew by 300% in 3 years. And a very old manager of mine said that anything that's growing by more than inflation times your nominal national growth, your real GDP, inflation times real GDP, could be an issue. So if we look at most industrialized countries, they might have inflation at, let's be generous and say 10%. They might have growth in real terms at 2 or 3%. So that statement, if I'd listened to that manager, says that anything that's growing by more than around 15% in a year could be an issue. And we've got SVB growing at 100% per year. So there were plenty of red flags. Anyway, what happened at SVB is that, as I'm sure we are all aware, SVB had some big bond holdings. The average return on those bonds was around about 1.7%. And when interest rates went up, such that you could, if you bought a new bond in the market, you could buy it at 3.7%, those banks were sitting on a 2% loss. Over a period of time, they would reflect this in their profit and loss. However, due to problems in with the technology firms started withdrawing deposits from SVB. When they did that, SVB had to sell some of its bonds and crystallize its losses. When it did that, that started to cause problems in the market, such that people sold the stock, people got concerned about SVB's viability, they started withdrawing more money, which intensified this problem. Then, nearly always the death knell for any organization, SVB said, we need to patch up our balance sheet, we need to do an equity issue, and as soon as you announce that, then everybody sells, everybody tries to get out, with ultimately the result that SVB failed. So part of the reason for SVB's failure was definitely to do with interest rates. And that is different to most of the other failures we've seen over the years. So kind of my first conclusion would be interest rates do matter, and there's something that bank management need to take very seriously. Some of this is summarized there. There we are. Interest rate movements, main factor contributing to the bank's demise. Now, there's a concept that banks report on something, when they're doing their results, they report on something called the net interest margin. Don't want to get too technical, but it's defined at the bottom there as their net interest income, remember on that profit and loss account, divided by a measure of their assets. And this chart is very instructive because to add to my weight that effect of interest rates does matter, we see here a period where a bank that I used to work for, NatWest, comes to the market, announces a small increase in its net interest margin, and that was one of the main reasons behind what happened to the share price. On the day that it announced, you'll see a big jump up in the share price. So more evidence that NIM is related to net interest income, which is related to interest rates. More evidence that interest rates are important to banks. And just, if we doubt whether they manage them or not, sometimes you'll see, it's a bit like me here. You can't tell what's happening underneath the lectern here. Yeah? I might be running as fast as I can. And it's a bit the same with interest rate risk management. If you look at the bar chart, that shows, the green line shows what happened to bank net interest margins in the UK over the period of the financial crisis. And you'll see it's relatively stable. If you look at the other chart for the same time period, you'll see what happened to interest rates. And you'll see they weren't stable, and in fact, they fell a long way. So your conclusion from those two must be that banks are running very hard under the surface to manage their interest rate exposure and to optimize their position. Okay? So all of this really is just a few slides to say, when it comes to interest rate risk, it does matter, and it's a topic that banks need to manage very carefully. Because if they don't, they could sustain very big losses, like SVB. if they do, they could get a big benefit from the market. Okay. That one looks boring, so we'll carry on. Just those conclusions. Right. Had I been talking technically, I might have gone through these. So initially, we just need to recognize that there are a few different ways of A, generating risk from interest rate movements, and B, measuring it and managing it. So don't worry, I'm not going to go into lots of depth. We'll just try a couple at the top level. In banking, those who are involved in risk management are worried about how much capital their bank has, and interest rate risk is something that banks are supposed to put part of their capital away for. And that's the middle block. And then the right-hand block is the Basel Committee, who, as you know, kind of guides the world on a lot of regulation, has a whole load of principles on how you should manage interest rate risk. And again, don't worry, I'm not going to bore you all with them, but they are in there. Okay, so just a little bit on the different types of interest rate risk, because you might be sat here thinking, oh, there's only one thing that can go wrong. Well, in practice, there's lots of things that can go wrong, and a good bank is managing all of these to the extent they apply. So the first two can be lumped together in something called gap risk, and in simple terms, that just means your assets and your liabilities, so your lending and your deposits, have a point in time when the price changes. So that if you, for example, have an asset that's linked to a very short-term market rate, when the short-term market rate changes, the price on your asset changes. So if we could just take the concept that all your lending and all your deposits, the price on them, the interest rate, changes from time to time. If, when you look at all the assets and the price on them, that changes at exactly the same time as when the liabilities and the deposits change, you have no interest rate risk. But in reality, that's not the case. Banks are complicated, their assets are repricing, the price is changing all of the time, and the same with the liabilities, and the net of those two causes this risk called gap risk. The second one, I'll say very quickly because it's boring and it's the least significant, and that is basis risk. So this may be that we have a loan that we make to a customer that the price changes in 3 months' time. And we also have a deposit from another customer and the price on that changes in 3 months' time as well. So on our gap risk, we say we haven't got any. However, there's lots of different what we call reference rates in the market. So our assets and liabilities may price off different reference rates. So examples are SONIA, SOFR, base rates, Fed funds rate, all of these, they're all reference rates. And if you have an asset priced off one and a liability priced off another, there may be a small gap between those reference rates, and that gives rise to this thing called basis risk. Now, the next two, prepayment risk and pipeline risk, are also very significant. So they both relate to whenever you do any fixed rate lending or any fixed rate deposits. So in the UK, we have lots of mortgages where we agree with the customer that the rate the customer pays is fixed for 5 years. Now, Once the customer has taken advantage of that, the customer has the choice whether to carry on for the whole period of that contract and carry on paying on his mortgage, or decide halfway through, I don't like this, I want to move to a different deal, maybe to a variable rate from a fixed rate. If the customer decides to do that, that's purely at the customer's option. So we say, when we're managing this, the customer has an embedded option. He can choose, or she can choose. Now, that can cause banks lots of challenges in trying to manage it. Because if all of you have got a mortgage, in fact, how many of you have got a mortgage? Come on. By the way, I paid mine off. So some of you, and some of you aren't willing to tell me. But those of you who have a mortgage that is fixed, you have this benefit. You can choose when you decide to move to a different lender or a different deal. The bank doesn't know what you're going to do. So that causes the bank a problem, because the bank's got to manage, you know my analogy of running very fast in the background? The bank has got to manage in the background what decisions you are all making collectively. So that's a bank's exposure to prepayment risk, and it applies to any fixed rate lending, but also any fixed rate deposits it's got. Exactly the same issue. Because a customer can give you a deposit and then decide they want it back early. Now, you may well say, come on, Chris, that's not a risk at all, because when the customers do this, you charge them a fee. Yeah? So you might have a fee for coming out of your mortgage early or from your deposit early. The point is, that fee generally does not equate to the market cost. That fee has to be set in a certain way that it's favorable or easy to understand for consumers. In most countries, if there's a fee at all, and the running bit in the background underneath the lectern is often more complicated, and that's related to what's happening in the money markets. And generally, the fee you charge the customers is generally less, on average, than the cost the bank has, and that's where this prepayment risk comes from. Similarly, if you decide to lend some money, so if you're in a big bank, most big banks, they don't have an individual offer for every customer. What they do is they have a tranche of money that they're prepared to lend to lots of customers. And then they advertise the rate. You know, we've got a mortgage at 4.9% for 5 years. Again, as soon as a bank does that, it's giving an option to its customers, because the customer has the option either to take the mortgage or not. And the bank doesn't know how many it's going to get. It may get nobody. It may get 5 times as many as it had assumed. So the result is, because the bank is trying to manage its exposure, what a bank would normally do is it lends money on a fixed rate mortgage, and then it borrows for the same term, and then it puts the two in balance. But if the bank doesn't know how much it's going to lend, because it doesn't know how many customers are going to take its offer up, it then has a problem. So something else to manage, and that's called pipeline risk. Now, Murad's told me I've got 5 minutes, so I just want to make sure I get to the nub of what happened with SVB and why that was an issue. So that just shows something called yield curves. And for those of you who are familiar, a yield curve shows the rate at which any borrower can borrow money for lots of different maturities. We'll put those on one side for a moment. The fact is, those yield curves can move in lots of different directions because expectations of what's happening to interest rates can change from day to day. Okay. So I just want you to look at this very simple picture. We have a bank that has 2 assets and 2 liabilities. This shows when we think those assets and those liabilities are going to change their price. So we have an asset and a liability, both of 100, where the price is going to change in 3 months' time. So there's no exposure. But further down, we have an asset, so we have agreed in our bank to lend money fixed for 5 years. And we've also taken a deposit from a customer where we have fixed the rate for 2 years. So that picture you see is called a repricing ladder. And if we relate this to what happened to SVB, there's 2 ways that a bank can try to assess its gap risk. One is by looking a year forward and trying to understand what the impact on its net interest income would be from interest rate movements. So I can tell you, making some assumptions, the impact in this case would be 0. The reason why I say that is because if interest rates go up, then what happens is nothing happens immediately, and then in 3 months' time, both our asset and our liability for 100, the price changes, goes up, and our net interest income remains the same. Our interest income goes up a bit, and our interest expense goes up a bit, okay? The other 2, we don't care about, because nothing's changing in the next year, okay? So in this simple case, we can say our bank doesn't have an exposure to its net interest income from a movement in interest rates. However, and I guess this will be my final point, Morad, this bank does have an exposure longer term because there's a gap between what's happening at 2 years and what's happening at 5 years on the asset and the liability side. So if we ran this through here, so look at the top, assumes no change in interest rates. So whatever they are today, they stay there for the next 5 years. And if you get a chance to look at these slides and look at the assumptions, you would see that our net interest income is constant over the 5-year period. In the second set of slides, you'll see that if interest rates go up, then our liability will start costing more in 2 years' time. Okay, so that liability that's repricing at 2 years, it will cost more in 2 years' time. So that means that initially, in year 1, our net interest income is the same, still 4, interest rates go up. However, from year 3 to year 5, our net interest income falls from 4 to 0. Now, this second way of looking at it, over the life of the assets and liabilities, is something that in the technical world is called economic value of equity or something like that. But it just means instead of when you look at an interest rate up or down, don't think about what's happening in the next year. That's what your management will mainly be focused on. You have to think about what's happening over the life of the assets and liabilities. And in this case, our bank has a real problem over the life if interest rates were to increase. This is exactly what happened at SVB. Their problem was, because they had to sell government bonds, they had to realise that problem that you see in years 3, 4 and 5, they had to realise it on day one. And that's what caused them their problem. All right, look, I think Murad's going to tell me, just shut up. Get off.
No, thank you very much. That was fantastic.
That's useful, and hopefully that helps your understanding of interest rate risk if you're not familiar with it. And if you, please, when the slides come out, please have a good look at them, because they go into lots of other boring stuff as well.
No, Chris, thank you very much. That's fantastic. Thank you. Now, unfortunately, in the interest of time, I don't have, does anyone have a burning question? I am going to make sure that this slide deck is sent to all, well, I'm going to ask that someone make sure, because I don't have all your emails. Feel free to give them to me. I'm going to make sure that ACI Jordan sends you this slide deck, every registered delegate, okay? Because I've had a couple of people say that to me already, so I'm going to make sure about that. We don't have time for questions. While I'm just talking, can you get your slides back? Can you go back to the slide that showed the upward one? Can we get the slides back?
Oh, yep.
Yeah, can you go back to the one that said, when you said I have a bit of sympathy with the rise in rates? Go back to that one. While he's doing that, what I felt was quite amusing, right at the beginning, when you show the rise in rates, the quick rise in rates, dollar rates. What I thought was quite amusing when he was going through all the different types of interest rate risk, all of which are valid, was Chris's reference to basis risk, which A, is a bit boring, and it's not that relevant. Yeah, I mean, and I found that quite amusing. Now, one other thing, just keep going. There, stop. Right, Chris said he had a bit of sympathy with the view that there was a rapid rise in rates. Now, I can understand, if you look at that chart, it does look a very aggressive rise in dollar rates, I agree. However, if you go further back out and you don't start from 2010, if you went back to, say, 1979, you take a higher level view, it was much more volatile in the Volcker regime of 1980 and 81. So my point was, while I agree with your sympathy point, if we all had a bit more attention to history of financial markets, we'll realize that it's rare for completely new risks to emerge, unless you're talking about some of the stuff today, like stable coins and climate change. But interest rate risk is a risk that we've been managing as bankers for 50, 60, 70 years, ever since the end of the Second World War, when we've had volatility in rates, or Bretton Woods, 1970s onwards. So we do need to have a bit more understanding of our history, because that wouldn't be as volatile if we started from 1979. Now, even I wasn't working in a bank in 1979. Yeah, I was at school, okay? But that's no excuse. We've all got to have an eye on the history so we're ready for when it repeats itself, because often history does. Chris, real fantastic, but I really enjoyed that. Thank you very much. Big round of applause. Thank you.